What have been some of your early experiences and learning?
So one thing I learned from him was invest. And I've always been a very open-minded person, and I have found the beauty in both the styles. They work at different time horizons.
And how did this style fit into Franklin's?
Franklin has a bias for quality companies at reasonable valuation.
So you spoke a lot about differentiating quality and value, and then ultimately it's the price that you pay for it. Right? In this world, how are you building that conviction?
The world can be different things at different points in time, but your process remains more or less the same at a very fundamental level, which is
How do you think retail investors actually view special situations versus?
see this whole thematic universe. It's a umbrella term.
How do you change your hat every time you manage another strategy? Today I have with me Kiran Sebastian. Kiran is a portfolio manager at Franklin Templeton AMC. He manages the Franklin India Opportunities Fund, the Multi-Cap Fund, and is the co-fund manager for the Build India Fund. He started his career in Franklin Templeton in 2015. Prior to joining Templeton, he worked as a lead analyst covering global equities at Arga Investment Management in India. He started his career in the asset management industry in 2007, covering European equities as an analyst at MFS Investment Management in London. He holds an MBA from Oxford University in London and obtained his BTech from University of Calicut in India. Sir, thank you so much for joining.
Pleasure.
So, you've managed money across multiple market cycles. What have been some of your early experiences and learnings?
Right. So I've been in the industry from 2007, late 2007, and I've been personally investing as a kid. So that's kind of the reason I ended up in the industry. So I've seen the ups and downs. So when I started my career, very next year we had a global financial crisis. So risk management was something that was very firmly entrenched in my process, and I always believe that in the long run, the performance is a function of how good the risk management is. And I was also influenced by some of the investors I came across in this journey. So my first firm was MFS Investment Management. I was working in London. So there was an investor called David Mannheim, phenomenal track record over a long time horizon. So one thing I learned from him was invest with time as your friend. So the meaning of that is he would invest in certain kind of companies where the companies inherently were getting stronger or getting better. So this is the original quality style of investing. Those days in the 90s and in the early 2000s, nobody really understood, why quality investing worked. Of course, it became a rage in the last decade. But this is something I pay attention to. I always ensure that there is a bit of my portfolio which is core, and there I'm invested in quality companies. Then I moved on to a value shop called Arga Investment Management, which that time was a startup. Today it's a very successful multi-billion-dollar firm. And I wanted to understand that style, and that was a very different world. I realized that you could actually make money in investing in these kind of companies as well, because I basically looked at a universe which I wouldn't touch with my growth and quality kind of approach. And I've always been a very open-minded person, and I have found the beauty in both the styles. They work at different time points in the cycles, but they do work if you execute them well. And so through this journey, I also realized that it's probably a good approach to blend both the styles. It gives you two different universes to fish from. So you'll always have a better universe of ideas to actually go into the portfolio. So I'm more of a blended kind of an investor in terms of my style, with a slight bias for quality stocks in the core side of the portfolio, with a very strong emphasis on risk management.
And how did this style fit into Franklin's philosophy of investing?
So Franklin's framework is called QGSV, where QGSV stands for quality, growth, sustainability, valuation. So Franklin has a bias for quality companies at reasonable valuation. And so we look at the quality of the financial metrics like ROE, ROCE, quality of the management and the drive they show in generating the growth, whether the market itself is growing, and whether the company is going over and above that to capture adjacent markets, adjacent geographies, etc. So it's very much the core of our investment philosophy, the QGSV framework. So within that framework, a value manager might be more leaning towards the valuation side of things. So might not go for the most highest quality business, but it's so cheap that they are kind of preferring that side of the spectrum. Whereas a growth manager might be on the other spectrum, where they really like high growth companies and they're willing to pay an extra higher multiple for that. And I blend both. So I have some of these and some of those, and I think both works fine if you do it well.
And with this style, there must be something that the market taught you as a lesson.
So touch wood, it's been like almost 4 years since I've been running a fund independently. So we have yet to go through a rough patch. But yes, you know the near misses, right? When you risk assess, you should be aware of something that's visible, but internally, no, this could have led to this. So you have to address things at the risk assessment stage itself. Near misses have to be counted as accidents. So one thing I learned, at least, looking at, so in my portfolio level, there is nothing that's really kind of gone out of control.
This was very interesting that you said, near misses also I consider as accidents.
Yes, I think the core of becoming a better investor is about self-reflection, and you have to be very honest with yourself. Sometimes you get lucky and sometimes you don't, and sometimes you put in all the right efforts and still you don't have anything to show. So that's very important. So I have seen, like in the last cycle, right, the 2005 to 2020, some of my friends who are portfolio managers also went through this, right? So, so that was a cycle where growth and quality was in favor, and value as a cycle underperformed. That was probably one of the longest periods where value as a factor did not really work in the few years before COVID. And I didn't see the point in labeling oneself as a value manager or a growth manager. I think if this is not working, if you have some other skill set, use it. And because end of the day, the retail money, it's not infinitely patient, right? Yeah. 3 years is what it will give you. Many a times these days it's 1 year, right? So I think that's another thing which I very consciously incorporated when I start running money, that I don't want style factors creating performance gaps in my portfolio. So I tell the investors, judge me on a three-year rolling basis, and I consciously try to blend these styles. And so far it seems to have worked. But I know there will be rough patches and there will be learnings. That's what the market makes you a better human being at the end of the day, and you have to stay humble and learn and adapt.
You spoke a lot about differentiating quality and value, and then ultimately it's the price that you pay for it, right? In this world, where prices are moving a lot faster than fundamentals, right? How are you building that conviction?
So, a world can be different things at different points in time, but your process remains more or less the same at a very fundamental level, which is mapping out the market. For example, if it's a sector like industrials, you have to split it up between, let's say, abrasives, AC companies, autocoms, like that. You have a sense of the fundamentals of that industry. That takes you to the earnings trajectory for some of those stocks in that universe. You put that alongside the valuation, which is currently those names are trading at. You can kind of get a sense from a 3-year standpoint what is the kind of upside. So in a very abstract sense, I have that sense for most of the market. What is my expected 3-year CAGR in this universe, and what is the risk? If the risk is very high, then the position size has to be smaller, vice versa. And then it's about placing it in that matrix, where you have the right combination at the portfolio level. So at all points in time, everything is competing. To me, right now, we are in a market where maybe the expected return is somewhere between 13 to 15%. So anything slightly above that, if I have something below that in my portfolio, that needs to leave, and something with a better return should go into the portfolio. So we do this with what is already in the portfolio, but we also compare what we don't have versus what we have, and if needed, we need to exit that position and include something else from the market. So So that's kind of the approach. And you're right, the market has been a bit choppy because partly it's tricky because the earnings have been disappointing, right? So there has been a risk on that front with slightly stretched valuations, plus a flurry of IPOs. But you do your best, and the good thing is that the market has broadened out so much. There's so much depth to the market, and you just need some 30-40 stocks to build a good portfolio. There are enough names available.
Speaking of building, you said position size, and you said that when it is favorable, I'll want to put some more money into that particular stock. Now, do you have a cap? Because when do you say no? Now I'll go overboard. Now I'll go beyond 10. Now I'll want to build that level of aggression.
So I operate with a limit of, actively I will limit an exposure at 8%. Passively, if it on that 8% it continues to run up over and above that, I am allowed to do it, but still I would probably, most likely I will restrict it. So historically I've gone as high as maybe 7%.
Even in your internal models?
Even on the?
Even in your models that you were running? You said that during your olden days you were running.
That's a model portfolio, right? Yeah, of course, I've taken those kind of weights. So, so when the market, so I think the whole game is about hanging in there, not blowing up. And there are those periods where you get very easy alpha, and then you have to be aggressive. That time you shouldn't be like very measured in your approach. Then you have to go heavy. But it's not like, don't be under the pressure to go and do something silly when it's a very tough market, because you might end up taking risks you are not comfortable with. So it's about striking that balance. But yeah, if I can get good risk adjusted return ideas, why not go for it? Full fledged, like a 5-6%, I'm game.
Okay. So the past couple of years, we have seen a very strong focus on thematic investing.
Yeah.
Some sort of special situation type of investing. Yeah. Right. How do you think retail investors actually view special situations versus how do we want them to view it?
See, this whole thematic universe, it's a umbrella term. It means there are different products under that, right? There are sector specific thematics, style specific, size specific. I mean, you can have any kind of stuff within that, a lot of business cycle funds. So I think one has to be very precise in terms of what exactly they're talking about. For example, one of the funds that I manage, it's a thematic special situations fund, and so the mandate is to invest in companies that are going through special situations, either some kind of changes, temporary challenges, regulatory changes, corporate M&A, all that falls under that criteria. And so that's one aspect of it, but that's not the complete aspect of it. So when you look at the product, you have to look at it from a full aspect of it. So the complete aspect of the product is that, so within those kind of ideas, we spot interesting themes. So there are certain interesting themes in the country. Digitalization is one such theme. Historically, we have played another theme called sustainable living, where we played the transition of energy from fossil fuels to green fuels, etc. So there are multiple themes. So then you can look at it from a market cap angle, large, mid, small. In what ratio do you want to blend it at different points in cycle? Then you can think of it from a style aspect. You want to be growth or you want to be value? How do you want to blend it? You can even take a call whether do you want to be abroad, because you have a certain limit which can go outside the country. There are certain themes which are not available in the country. You can do that. It's an active call. So the portfolio is a function of all these active factors which the portfolio manager manages within the constraints of or within the mandate of the product. So when one looks at thematic, one should understand that aspect. At a very simplistic level, a thematic fund is a sector fund. You want IT exposure, you just go and buy IT. Of course, the issue there is that IT might be in favor, at some point in time. It might go out of favor at some point in time. And the person has to actively make that call. In the case of the opportunities fund, for example, the portfolio manager decides which theme has to be scaled up, which theme has to be scaled down, etc. So in a way, it's dynamic in terms of the factor allocations that are happening within the product.
And you manage multiple strategies also. So how do you change your hat every time you manage another strategy?
So the other fund I manage is the multi-cap fund. So yeah, it's a good point. So the origins or the real thought process is the same. Um, so what is it fundamentally, right? Fundamentally, I am a blended guy in terms of the style. So bulk of the portfolio is quality GARP, but I'm willing to go to that unfavorable, unloved part of the market also. That remains the same. Get interesting themes into the fund, let's say rising affluence, make in India, digitalization. Those needs to be in the fund, because my fundamental view is that today's theme create the benchmarks of tomorrow. Benchmark is backward looking, so benchmark should not be the anchor.
I will ask you that as well.
Sure, sure. So that aspect is there, and to that extent, we are benchmark irreverent. We are slightly more respectful in the case of multi-cap because it's a very standard type of a product, and within that category, we are slightly maybe a bit adventurous, but it's not as adventurous as India Opportunities, which is a thematic special situations fund. But we are not afraid to deviate from the benchmark. A lot more in opportunities fund, which is a thematic fund, but a lot less in the case of a multi-cap fund. So that's how I look at it. So we are willing to take differentiated sector calls. We are willing to we make sure that we include the interesting themes into the fund. But multi-cap is slightly more conservatively managed. Opportunities is like up to your imagination. So and hence it can cut both ways. If all the active calls are turning out fine, it can be a superior product. But if it doesn't always work out exactly at the time you want it to work out also. So it's going to be a slightly more volatile product. But hopefully on a 3-year rolling basis, it compensates for that.
Now, because of this aggression that the India Opportunities Fund has, it does involve less certainty. So, most of the calls are going to be more event driven and they are not always a long duration play. Can you give us some examples of how you picked certain themes that worked and some that did not? I also want to know what happens when something doesn't work. How do you manage that risk and change your approach?
So something I'll start from the bottom. Okay, something that doesn't work. The three things how we deal with it. You have to deal with it, obviously. So one is you go back after 6 months and say you've not done anything for me. Okay, why do I keep you? So you have to either kind of listen to the stock and say, okay, you're not going to deliver, so you get out of the portfolio, right? Other thing is saying that, hey, I'm a bit slow, but give me more time. I'm going to work. So you have to give it more time. Or other thing is that market has misunderstood me, but I'm even cheaper now. So you double down. So we have a good history in terms of doubling down and creating alpha. So first year it will be a drag on the portfolio, then in the second year. So it's you have to kind of choose between these three and deal with it. But you have to kind of address it. You cannot just hope that it stays at that corner in the portfolio and magically fixes itself.
And how do you address it? Do you sit in a room with the analysts, or how does that process take place to say, okay, now let's reevaluate?
It's the fundamental thesis and the drift. Usually, at least lately, it's been an earnings drift, many cases. So if it's an earnings drift, is it because the macro has gone down? Then it's understandable macro. Or if they have over-guided, they have misled. Is it a management that cannot execute what they say? So you have to take all these calls, and basically it will translate to a revised earnings forecast. And on that basis, is it still giving you that minimum CAGR returns from a 3-year type of time horizon? So that's the kind of approach we take. Now coming to the other point, which was theme, the framework is very simple. We should be convinced. So the framework for theme selection is conviction in the theme. We prefer long duration themes, so longevity. And third is availability of good quality businesses at reasonable valuations. So theme can be hot, but there's no money to be made because stocks are fully valued. So if you remember, I'll give you different examples. So make in India, for example, we kind of very early in terms of 2022, we pivoted into that theme. 40% of the fund was in that theme. So we were pretty much not touching half of the market during that time. Make in India plus that whole utility power theme was almost half of the fund. So we could clearly see signs of private sector coming back because we had underinvested in the previous 10 years. Government side of capex was anyway very strong. And it appeared like even the household side, which is a residential real estate cycle, was starting to revive. And you could see many stocks that could benefit. So that cluster kind of created the Make in India universe. And within that specifically, if you see, let's say within the defense context, we were very early. We could see that in the Air Force side, for example, there was a structure. So different themes have different longevity. Defense is a long gestation cycle. We could see a very structural story where incrementally the platforms, aircraft platforms getting inducted into the Air Force are going to be India made, which was not the case historically. So that was a big structural shift, and that comes with its aftermarket revenue streams, etc. So we bet very heavily into some of the defense type of exposure. But of course, a certain valuation you have to come to take your money out also. So that's one example of entering into a theme and entering into a name. Exiting, for example, only once we have done this, we exited that power related theme, which we call sustainable living, where the theme worked very beautifully for us, but stocks had become expensive a year ago, and we kind of scaled down and we entered another theme called rising affluence, which is a consumption linked theme. So that's the kind of framework in terms of how we think about the themes.
But sometimes, your the quality at a reasonable price, which also means that, these are names that continue to compound, but they remain expensive. What does an investor do at that point? Do you stay invested, or you say, no, let me just take out my money? Because always when you're at the wheel, you'll be like, okay, I might not get this opportunity back to own this business again. So at that point, what do you do?
So it's again boils down to what is my expected 3-year CAGR from this stock. So sometimes you can let it stay for a bit longer if you think the earnings momentum is going to be so strong. But my general tendency has been historically to leave the party a bit early. So I commit more of that error than overstaying. Maybe a bit also because of my value background. So that's been my error. I'm fine with it. So you can't just wait for the near term good news or bad news. We are not good in timing that way. So we have to trust the valuation. So I have to, because I am running such a benchmark agnostic portfolio, I need some kind of an anchor. And in my process, that anchor has to be valuation. Just because of near term momentum, if I keep riding, one day I will blow up. I don't know when. So it's better to stick to the process and self correct before that happens.
Now, we spoke about benchmark.
Yeah.
We said India ops won't have too much of benchmark names at all. So how do you expect the role of active management of fund managers to evolve over the next 10 to 15 years?
Active management will remain relevant always because market is like a complex adaptive system, right? If imagine everything was an ETF, then there will be so much alpha left on the table because everything thinks alike. So, but of course, I don't think earlier I would say a bright human being is the apex predator in this whole jungle. Now that may not be the case. It might be a algorithm. It might be an AI. So that way, I think you have to be very open-minded, and what drives you is your inherent passion for businesses. Otherwise, there's no way you would want to do this on a day-to-day basis. There is fun in it, especially when you have a good team working with you. And stay open-minded, and be curious, and you have to learn fast and adapt. I think that's the name of the game for active investors. But the market will have other kind of participants also. There will be more passives, there will be more quant funds, and there will be a class of active investors who will continue to generate substantial alpha. That is how I look at it.
Are you using any AI tools?
Not in the investment decision making phase. In terms of workflow optimization, I do. Like quickly you want to learn something, summarize something, make comparisons. So in all those aspects, I do use a couple of them.
And you put your own data on it and then talk to it, or do you say, okay?
Yeah, I think we can't upload our data into any of those things. So the two of them are, I think, different vendors are approved or different solutions are approved by the firm. In the India context, we have at least two of them approved, and I use two of them.
Now, outlier question on the benchmark. Do you see a Nifty special situations index coming up?
Nifty special situation index coming. A tricky one for me. I don't think, at least, yeah, I'm not expecting someone to.
Or imagine if something like this comes up on the passive side. How would that look like?
Yeah, I think it's not hard to imagine, but I told, right? So this is one attribute of the product. So a special situation is one attribute of the product. And you can have, all the companies are announcing a special situation, you can create a basket. But I don't know, by just that attribute alone will give you the alpha you want. So you have to backtest and see. So the product should have multiple attributes in terms of, how the portfolio manager conducts the portfolio and the strategy. So I think within the that basket also, I think if there is a good strategy, why not? That's what I'm thinking, but I'm not aware of anything like that at the moment.
No, there's nothing announced. Okay. It's just a first. I hope they see it. It's the first conversation that you probably.
You are creating competition for me, basically.
So with the markets constantly throwing new information, what are some of your daily habits or routines that help you stay grounded and aligned?
See, the good thing in this job is that you don't have to own every stock. But it's important that you know what you're owning. So I at least don't put too much pressure on me to kind of follow every IPO, and because it's just not possible any longer. The kind of information flows, right? In fact, if I could advocate for half-yearly reporting instead of quarterly reporting, I would do it. Because I don't think we are investing for the long run. I think that's what really creates the substantial wealth. And this quarterly trading releases and monthly sales volumes and all, that's all noise in the system. So fundamentally, a good management doing good capital allocation for a long period of time with good drive in terms of growth, I think that will create alpha. So my routines is, whatever I own, I should be on top of those names, all news. So I have various screens where I get the news flow. Then I have a broader universe which I track, multiple universes I track, where I have tracked the price action, and sometimes the price is a leading indicator of fundamentals. So when there is interesting price action, you have to go and explore what is the story here. Then, of course, global news flow. You have to track these. I've always been very plugged in terms of, because I have a global equity background. So US, China, anti-involution, AI trade, all these things, you should have some sense of what's going on globally. Then talk to your colleagues and the research team. A lot of things come out of them. So that's about it. And of course, then there's always few names I'm always working on. Long-term, kind of doing deeper work. That's kind of building the pipeline for future. At some point, and I'll have a buy price, it will go into my sheet, and someday it might enter my portfolio.
Speaking of alpha and future, what are some of the structural themes or sectors do you believe is pretty underappreciated right now in India?
So right now, my opportunities fund, for example, is invested in digitalization as a theme. In fact, when we entered this theme in 2022, it was like a completely out of favor. Okay, so remember 2022 is when NASDAQ was crashing, all the tech related names were kind of correcting massively, right? So I felt this is a great theme for India, because imagine, right, in the old days, when you get down from an auto, you will be like scouting for change. Now you just use your UPI, and so the digitalization of the economy is real, and I think it's a structural trend, and these are the very early days for India. And so that universe itself of digitally or digital savvy or digital native companies, 10 years ago we had only one or two names there. Now we have so many names, and that universe will expand, and many of those companies have inherent moats. And I think there's a lot of value to be created in that universe, so it makes sense to be more focused there. So that's one theme. Then I do like the theme of localization of manufacturing. I think that's a structural theme, be it electronics, defense, all those themes are real. Energy transition to green fuels is a structural theme. India, end of the day, is a consumption driven economy. And within that, also, there is a cohort of extremely high net worth individuals. And there is the mass Indians who are moving up in terms of their disposable income levels and consumption. So, rising affluence is a structural theme. So, there are a lot of interesting themes. And within these, there are micro themes also, like sectoral levels. So, there are a lot of interesting themes within the country.
And managing this sort of a strategy is very stressful. How do you recharge outside of work?
Right. So it shouldn't be stressful. It's not meant to be stressful. And I always think so there is an optimal level of stress, right? It should be there where the optimal level of stress is where your performance is just right. So any stress beyond that, your performance goes down and it's not good for your health. And at the same time, you shouldn't take it too easy and too chill also. Thankfully, thanks to the team and the colleagues I have, it's been easy in the sense that, yeah, I beat myself up, but at the same time, I have to be kind also with myself. And so far, we have been having a smooth journey. Routine wise, it's my simple rule is that life is about balancing a few things. You have to breathe correct, you have to eat correct, rest correct, sleep correct, or sorry, stress management. So, stress management is friends, music, badminton, all these things I do. Then the rest of the other things also, at least I am cognizant of how I'm doing those things. So that's the kind of things you manage. Then I think everything, whatever happens beyond that, again, I don't beat myself based on the outcome. Every day I show up and put in the good effort. There are years, initial years, the effort, I mean, we get too much alpha for the effort we put in. Now you have to kind of fight tooth and nail for the alpha. Markets are sometimes very hard. That's the nature of the job. So just hang in there and do your karma, and whatever has to happen will happen.
Now, for someone early in their investing journey, somebody in their 20s and 30s,
Yeah.
what are the three things that they should actually focus on to build a strong foundation?
So if you're early in your career, I think the first thing is ensure you end up doing something which you enjoy doing. I don't think anything is worth living a miserable life for 20 years, hoping to retire after that. So do whatever career change is needed in the first 4 or 5 years and land up at a place where you are comfortable, and that will eventually lead to better earnings power also. Second thing is delayed gratification. So don't go and buy your iPhone with the first salary. It can wait 2 or 3 years. So take out some money for savings and invest in long-term assets. Equities is a good one. So that is what I always tell youngsters: get the foundation right and try to invest, start the habit of investing.
And finally, if you had to give M2W investors one rule for building wealth across multiple cycles, what would that be?
I think it's the key is to get the asset allocation right. I don't think people are educated enough about it. So at least understand what are the major asset classes and their properties. For example, equities historically would have given you, let's say, 15% return. But equities, there are points in time it's down 60% also, right? So people should understand this is the nature of the beast. And you are able to get that kind of a higher return because you are willing to live through that kind of drawdown, right? And the good thing about your actual return, I mean, how it works is that your actual return is more likely to converge with the asset class return the longer your time horizon. So understand the asset class, take a relook every year. It's less like going for your annual health checkup, and rebalance if needed. But once you're signed up for an asset allocation, don't overthink. Don't, with every market fall, don't go and take the money out and try to be too smart. So once you get the asset allocation right, then you can think about what product within that asset allocation. So within equity, it can be a multi-cap fund, an opportunities fund, a flexi-cap fund. So, and work with your relationship manager or somebody who understands these products to choose the right product for you.
Done. Thank you so much for your time. I had a pleasure having this conversation with you. Again, we will have one more conversation later. Until then, I wish you all the best.
Thank you, and thanks for having me here.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.